Hello, everyone. Welcome to our series, Alumni Hour. I'm excited to be here with Brad, and I'll tell you a little bit more about Brad, but I also here have Julian, and soon we'll have Joe join us for the financial literacy journey. So why we're doing financial literacy? Well, it's April, so it's Financial Literacy Month. But we're excited to have, as I mentioned, Brad Williams, who is a principal at CZ Capital, and I'll let him tell you a little bit more about what he does there and what that all means. But really what we're going to dive into is really on the world of financial literacy. We know that it's not taught in schools, so that's why we're bringing it to you. We really want to expand your exposure to financial literacy and how Brad and Joe's journey could help you kind of relate to careers that you might have not thought about. So what we're going to do is we're going to let Brad introduce himself, share a little bit about his story, and then Julian and I just got some questions for him, and then we'll just have a conversation about what really financial literacy is all about. So with that, Brad, take it away.
Hey, Brad, you're still muted.
Thank you. I realized that as I was going. Sorry about that. So I graduated college in 2010 and started working in investment banking in the mergers and acquisitions group at Barclays. And then I joined a private equity firm called Crestview Partners in 2012. And private equity is basically finding mature businesses, buying them, attempting to make them better, whether it's growing faster, more efficient, more profitable, more diversified, more global. There are lots of different ways that we can attempt to do this with a business, but ultimately look to sell it for significantly more than we paid for, kind of a 5 to 7 year period after that. So I've been doing that since 2012. I left Crestview a couple of years ago to join a firm called CZ Capital, which does more of the same. But really excited to be here talking.
That's awesome. And I definitely want to dive into a lot of the private equity part. I was sharing with you earlier that my only connection to what you do, which is all, I mean, it's really, I don't know if it's true, so I'd love to get your thoughts. It's really just about the show with Marcus Lamont. So maybe you can demystify some of the truth, or maybe that is true. That's really how it all works.
So I would say it's somewhat true. So my firm tends to invest in slightly larger and kind of more sophisticated businesses than the ones he's focusing on. But we are often, I'd say there are two different forms of private equity. One form is a company that's in really good standing and is doing very well, but needs more money to grow, whether it's to start a new product or enter a new company or whatever. And other times they're companies that are struggling. This is probably more similar to what you see on the show, but those companies maybe need more working capital to be able to buy inventory and sell products. Maybe they need to, invest in a new manufacturing facility to be able to sell products. Lots of different ways that can happen as well. I would say the biggest difference is that usually we are buying like a control stake in the company. Marcus is usually making minority investments. And we also do our investments with a lot of leverage. So similar to when you buy a house, you take out a mortgage, which probably represents the vast majority of the money that actually goes to pay for that house. When we buy a business, we similarly are raising a lot of debt to help finance the purchase of a business.
That's awesome. And for those of you who don't know Marcus, who you haven't watched the show is called The Profit. So check it out. I think it's pretty amusing. Some might think he's a little rude, but hey, it's business, right? So, Brad, I'm gonna just hit you with the first question, and there, the reason is because there's so much information out there about financial literacy. So if we go with the basics, right? So the budgeting, the savings, the debt, the investments, and really the taxes. There's so much, and quite frankly, one might get stuck and not even know where to get started. So where do I go and start learning about financial literacy?
Yes, I would say the best place to start to learn or think about this stuff is simple things like the Wall Street Journal, the New York Times, CNBC.com, or CNBC on television if you like to kind of have it on in the background and watch it actively. There's tons of news and stories out there about different interesting sectors of the economy and other places where you can kind of put your money, what we call, to work to try and return for you. The biggest thing I would say in thinking about entering this journey of financial literacy is to recognize and know your limitations and don't try to get what we call over your skis. There's a famous quote by Warren Buffett that money ceases to be dumb when it knows its limitations. And so the more that you kind of understand what you know and what you don't know, the better off you'll be kind of not trying to delve into things that you're not as familiar with or think that you can get ahead on something that is new. So knowing and understanding your limitations is a big part of entering that journey. And the first way to start that is reading the news, watching kind of interesting shows about the markets and other things related.
Not bad. I couldn't agree more with you, Brad. Definitely, those are definitely things that I tune into every once in a while. Definitely, just to spark my interest as well. So I kind of want to shift the conversation over to kind of investing a little bit on the importance of investing. What exactly is investing, and why is it important to invest early? Actually, as well too, though. So for me, I know that I didn't start investing until later on. And I could kind of understand the importance of why I should have been investing earlier. But could you explain the importance of investing early and what exactly is investing?
Yeah, so it's a good question. What is investing? I would think of that as paying a price for ownership in a thing. And that thing can be lots of different securities. It can be a piece of debt where you own kind of an investment that basically returns a fixed coupon of cash. It can be owning equity in a business, which doesn't return a fixed coupon, but allows you to benefit as the company grows in value. But it's basically paying a price for something in the hopes that it will either grow in value or generate enough cash flow that it creates what we call an attractive yield. That's the best way I can define investing. I'm sure the internet can probably do it better than I can, but on the spot, that's the best that I got. And then remind me of the second question.
Yeah, the second question, why is it
important to invest early? So much of people, I hate to use all of these idioms that you can find on the internet, but they talk about the power of compounding interest being like the eighth wonder of the world or ninth wonder of the world. Not many there actually are, but it's the incremental one. And the power of investing early is just that your money continues to work for you, right? So if you're investing in something that generates a stable 10% return over time, your money turns into significantly more than it would have been just generating a 10% return independent, because that 10% becomes part of the baseline on which the next 10% grows. So over time, that's a really, really powerful force. There's math. I wish I had it in advance, but there's math that you can run that tells you how powerful it is compared to kind of static investing or getting into the game a little bit later. So the earlier you can do it, the better. It's also you're better off just from a tax basis owning things for longer. We can talk about it later as it comes up in the conversation. But the thing that people often overlook is how impactful, sorry, the people in the background, how impactful taxes can be on your ultimate kind of return. Because at the end of the day, what you should really care about is the money that goes into your pocket, not kind of some aggregate gross value of what you own. And at least for now, it may change over time. The government has determined that money that you invest for a longer time should be taxed at a lower rate because it's efficient and effective for the economy to incentivize people investing.
Thank you. I have a quick follow-up question based on that as well. So what are some things that people can invest in, right? So if I don't know anything about investment, what could I possibly invest in?
It's a great question. And I would say the number one thing, back to the Warren Buffett quote, that I would recommend for people who are just starting to kind of get involved in the market is buy what people call exchange traded funds or index funds. These are basically broad baskets of stocks that represent either the entire stock market, or you can get sector specific ones focused on technology or energy or consumer or whatever. But these basically eliminate all of what we call idiosyncratic risk, or like the risk that any individual company won't do well. And instead you take all of the kind of broader market risk, which is to say you benefit as the economy grows, as the stock market grows, but you don't have to be sophisticated or smart or spend the time to like find specific stocks if you think of the right winners. So personally, outside of stuff that I invest in and work, and even though I spend a lot of time focused on investing, all of my individual assets are in index funds. I don't invest in any individual stocks personally. I'm not going to ever, invest in crypto that will turn into 1,000 times my money overnight. But at the same time, I'm not going to invest in stuff that's going to disappear overnight. a very stable and calm way to have your money appreciate over time. Hopefully, I think over the last 70 years, the stock market on average returned 7% consistently over the long term, which is exactly what you should be thinking and looking to do when you invest. So that's absolutely what I would recommend. If you want to get more sophisticated, maybe you get one domestic ETF and one international one so that you have a little bit of exposure to other parts of the world as well. But it allows you to get exposure without needing to do individual stocks.
So this is kind of a good segue into that question that you just answered. But think about like paying for college, right? So we know the cost of college education has significantly increased over the years. So imagine you have some kids already and you're thinking about saving for college for them. What investment avenues would you recommend our parents take?
Yeah, so there are a couple of things you can do. One, and don't quote me on the number, Google it to keep me honest, but I think there's a tax break called a 529 plan where you can basically allocate a portion of your current income to a tax-free account that you can invest on, basically to pay education expenses for your kids. So the younger they are, as we talked about earlier, compounding interest is a very powerful thing. But do the research on how 529 plan works and try to allocate as much tax-efficient dollars as you can to investments in ETFs or other things like that. So that's one thing I would say. Another thing I would say, again, going back to ETFs, that's probably what I would recommend for almost anyone, unless you have some reason why you think some stocks are going to perform really well, but you should appreciate all the risk embedded within that. So ETFs are probably, there may be other, if you're really, really, really focused on managing risk, maybe you want to invest in bonds or like treasury securities, other things that have significantly less risk. And since your biggest priority is making sure that you actually maintain the capital you have. So maybe you want to go slightly lower on the risk totem pole and do a debt investment, but all in line, try to find tax efficient ways to do it, which 529 plans can be. And I would say invest in things that are probably lower risk, since your biggest goal is to have an adequate amount of money to pay for education, whether it's for you, your kids, or
That's awesome. And I mean, starting early is key, right? Because, right now you probably, if you're footing the bill for 4 years, you'll probably need easily $250,000 to be able to pay for college for your kid. So that hopefully by the time our kids are in college, there has been some significant change, but really starting early investing is key.
Absolutely. And have a goal, try to understand what you're working towards. And if you want to be nerdy, like do math on what you will actually need to put away each time, what you expect the return is going to be each time to ultimately get you there. Maybe it ends up being daunting, but it'll help you at least have a really good understanding of what you actually need to do, so that you're not kind of investing in the dark. Yeah.
Thank you, Brad. Thank you. I kept hearing the word risk, right? And when I hear the word risk, right? So risk usually associates to a lot of mistakes. Usually, so what is one of your money mistakes you have made and regretted the most? Or what are some, mistakes that you may have known friends who have made that they possibly have regretted? But what is something a money mistake that you made early on or possibly made currently?
Yeah, so what I would first say is I wouldn't be scared of risk per se, right? Risk is really the only way that you can actually make money in investing. Fundamentally, what you want to do is invest in things that are attractive on like a risk-adjusted basis. So the upside opportunity should compensate you for the risk that you're taking, which is to say like the risk that you lose all of your money in it. But the biggest money mistake I made is one related to taxes. I didn't really appreciate or understand. I didn't come from like a terribly financially sophisticated family. So when I was young, someone in my family bought me some Apple stock, which I don't remember what year they bought it, but it grew significantly. So it was worth a lot of money. And I decided that I would use some of that money to help pay for business school. And so I ultimately sold the shares, but that was stupid because the Apple's worth a lot more than it was when I sold them. But even more importantly, I didn't really think through the tax consequences of that. And so I didn't have kind of a full appreciation for what actual money I would have for myself versus, the money that kind of existed in this account, which isn't necessarily yours. And so thinking through the tax consequences and the implications of when you sell, how you sell, etc., is something that I wish I understood better at the time, and certainly have a much more acute understanding of now.
Absolutely, absolutely. Thank you for that, Brad. Joseph, I'm not sure if you can hear me, but I will actually follow up with the same question for you. If you could just, jump right in there for us. What was a money mistake that you made early on, or currently making now, or definitely, yeah, what was a mistake that you made? A money mistake, actually.
Good question. Can everyone hear me? My video is just not showing well from my end.
Yes, we can hear you great.
Okay,
Joseph.
good.
Joining us.
So I think the biggest money mistake that I made, when I was new to my industry, I bumped into people who were in the financial world for longer than I, and I let that kind of cloud my vision. And one of these people in my circle, so to say, they were providing a stock tip and talking about it as though it was a guaranteed win. So I invested more than I should have at the age I was at. And this person, hey, they had enough, they were much older, so they were risking money where I was taking money that really should be allocated for savings. And I got excited and I thought, hey, this person's been around, not realizing that, some sort of high risk stock like that could go well, or it could go the other way as well. So while it was a mistake in the moment, it actually was a great life lesson of really realizing anytime I go into now, whether it's a real estate venture or a business venture or an investment, I'm aware that, hey, things go good and things also could go sour, and you have to make sure that you can handle the downside. So it was a mistake in the moment, but wound up being a really valuable lesson, because I lost, at the time it felt like a large amount of money, but relatively speaking for the age I was at, et cetera. So it has, now I remember that always. So sometimes when I go over, I was looking at a real estate flip recently to get involved in, and that little voice actually came back to my mind and brought me back, because the contractor was talking about all the positives and he wasn't speaking about how the market's really hot in this area right now and things like I knew. And there was this side of me, of course, you want to jump in because it's exciting. But I remembered that, and it caused me to go a different course just based on what I thought was right for me. So that was my biggest mistake. And I would kind of say to make sure when you're looking at money decisions, you don't let emotion get in your way of logic, and you sit back and kind of, think out or write out or speak to some people you trust and think about what will occur if it goes right. You don't want to be too negative, but also you don't want to be blindly optimistic.
I think that's a great lesson that we all can take. Joe, since you're just joining us, just for the benefit of the audience, we asked Brad the same question, if he can introduce himself, share a little bit about his background, his schooling, where he is now, and then we'll continue with the questions.
Absolutely. Thank you. So I'm born and raised in New Jersey. I went to college at Ramapo College, New Jersey State School. While I studied finance, my career is as a financial advisor. I work predominantly with individuals and business owners. And what I do is I help people figure out how to ultimately manage their money. Everything from saving for retirement, investing for the short term or long term, paying off debts, purchasing different types of insurance like life insurance, disability insurance, acting in all areas of wealth management, both on how do you create wealth and how do you protect it. I realized I wanted to go down this path because I knew a family friend who was very successful in the industry when I was growing up. And I knew it was a career where you really get to create your own destiny. You build your client base, you get to help people, which I think is awesome. You get to meet a lot of people and really be involved in their life because they're coming to you with their concerns about money. So you're learning about what's important to them, what's going on in their family, their business life, their financial life. And so it's extremely rewarding. And I studied finance. I interned at a financial firm, and then right when I graduated, I started at the firm I'm at, Northeast Financial. And kind of the beginning is very tough, at least in the line of financial planning, the route I went, where you pretty much become a registered advisor, and then it's, hey, go out and find some clients. And I was 22 years old. A year ago, everyone saw me at a party or whatever it is, and all of a sudden it's, hey, can I be your financial advisor? So it was quite difficult in the beginning, but it's one of those, like most careers, if you stay at it and you're disciplined and you're dedicated and you focus on doing the best work you possibly can. What happened was I slowly built a client base, and those clients who were happy, if I did good work by them, they slowly introduced me to others. And then it had a compounding impact where now I've been lucky from kind of starting from there to have close to 1,000 clients, have built a team, have built out my own office. And it's a cool career path where you can really have an entrepreneurial route while helping people and have, unlimited income potential.
That's awesome. And I think that's we're going to ask you another question that we asked Brad. And I think this goes really well based on what you shared in terms of having to build your clientele. So we've been talking about investing, right? So we hear a lot that people emphasize investing early and why that's the case. But also, what avenues would you recommend, investment avenues would you recommend for parents who want to help save money for their kids to go to college?
Great question. So, it's a little cliche, and I'll definitely get more specific, but it's just so true that there's never a black and white answer. Everyone's situation is different. I mean, sometimes I have clients where it makes sense to look to utilizing something as creative as equity in a home to help fund college, or unique methods. But there's in depending on the age of your child and how many years until schooling, there's some great vehicles out there like 529 accounts. Depending on your state, they come with different tax benefits, but they are designed to help with education. I would kind of circle back to, though, the process is much more important than the product. So becoming aware of what you're looking to accomplish, and then doing your due diligence of research, or if you're confused, interview a bunch of advisors and find someone who you connect well with, get a few different people's opinions, because how much money you're looking to save, how much money you can save, your financial picture, how many years are left, all kind of dictate what vehicle you should place the money into, if that is the best strategy. Maybe it's not. Maybe financing, education, and focusing on other areas of your financial life are more important. And that's where an advisor can really help you kind of navigate through all those difficult decisions. 529s is the most common vehicle, but it's definitely not always the right vehicle. And just always like to stress, the process is much more important than the product.
Thank you so much. That was really helpful.
Absolutely. Yeah, thank you for that valuable insight. So I'm going to, this next question, I'll definitely open it back up to both of you. There's a lot of things that people don't really necessarily tell you when it comes to investing, when it comes to budgeting. So what are things people aren't telling you when it comes to investments, such as fees and taxes? So either Bradford or Joseph, feel free to jump right in. After the first panelist is done presenting, the next one can jump right on in. Feel free to answer the question. So the question again is, what are things that people don't tell you when it comes to investments, such as fees and taxes?
You want to go, Bradford, or?
Go for it.
Okay, cool.
Your experience is more germane to this.
So I'd say, you know, the concept in general, when I speak to clients about this all the time, the wealth being created or the picture being painted is almost like the iceberg above the water. The fees, taxes, inflation, market fluctuations, all these sorts of things, the wealth eroding factors is the bigger part of the iceberg and almost the more important. So overall, I'd say it's just a lot of times, like I'll read these different articles and we'll talk about maybe compounding of interest, but they're not at the same time talking about compounding of tax or even compounding of fees inside of an account. You know, if you're paying a management fee for a mutual fund or whatever it may be, as that account builds, so does that fee involved. And the same thing can occur for taxes. If you're building wealth, depending on the account you're investing in, you can be compounding that tax as well. And understanding fees and taxes, because if we can reduce them, that's a rate of return in and of itself. So simple ways, I don't want to talk so high level without giving some valuable information that people can act on their own. So I'll just give a little tidbit on a tax, depending on where your income's at, which product could be right for you, but a 401k, IRAs, qualified plans, and some other accounts as well. You can get some tax deferred growth inside of life insurance contracts too, believe it or not. But inside of the investment accounts, those qualified accounts, you can have that tax, whether it's a Roth or traditional, the tax difference, but you can buy and sell funds without getting taxed along the way, which can be very valuable. Because if you're just investing in a brokerage account, you buy a stock and you sell it, or you earn dividends, your snowball's melting a little bit. And every time you pay that tax, you're not just paying that tax, you're ultimately the lost opportunity cost of what that tax could have earned for you if it was still in the account compounding.
Thank you, Joseph. Man, such invaluable information there. Bradford, exact same question. What are the things that people aren't telling us when it comes to investment about taxes and fees?
Yeah, so I totally agree with everything Joe said, and I would say the other thing I would add is people, especially mutual funds, have gotten really creative with the way they characterize or call them fees. A lot of times they call them expense ratios or other things that are similar, but it's all really the same thing in the sense that they're all drags to what your ultimate return is as an investor. So be careful, read the fine print in terms of other ways and things that can impact the returns that you get as compared to what people are quoting or sharing with you. Part A. And part B, and this is perhaps less specific to taxes, but much more so kind of fees and generally. Pay attention to what the interests are of the people who are bringing you investment ideas. What do they have to gain from it? How do they get paid? How do all of those things factor in? At the end of the day, your best scenario is to kind of have aligned interests with people who you think are bringing you opportunities. And so having a good sense of how other people are getting paid with opportunities that they're bringing you is a helpful way to make sure that if you're paying fees, which may or may not be inevitable, that they're at least ones that are with your in the way that you plan to grow your wealth and assets over time.
That's awesome. Well, those are all the questions we had for you all. And I, on behalf of Julian and I and the whole Alumni Network, we just want to give you, Brad and Joe, a warm thank you for sharing your knowledge with us, sharing your path to where you are now. And we wish you great success in your future, and definitely appreciate all the tips that you share there. So thank you.
Thank you for having me. I appreciate it.
Yeah, absolutely. It was a lot of fun.
And we'll do this again, hopefully soon.
Awesome.
Awesome.
We'll play in person one day.
Yes.
Totally.
All right. Bye now.
All right, guys. Take care.
See ya. Thanks. Bye.
Yep.